Really is. An economic moat basically is a sustainable competitive advantage. It's what allows a company to earn profits above its cost of capital for a long, long time by keeping competitors at bay.
Because success attracts competition. Right. Everyone wants a piece of the pie.
Exactly. In a truly free market, high profits get competed away pretty quickly unless there's something protecting that company. A moat is that protection. It's what keeps a great company great instead of just fading back into the pack.
So how do you spot one? You look for those high profits consistently and then try to figure out why.
That's the process. First, look for the evidence. Consistently high returns on capital, strong free cash flow generation, healthy profit margins, high ROE, high ROA, sustained over years. That suggests a moat might exist. Then, you have to identify the source of that moat, what's actually keeping the competition out.
Okay, the book lists a few main sources. First one is product differentiation.
Right. Having a product that's truly unique, or at least perceived as unique by customers, maybe due to branding or features, think maybe certain luxury goods or powerful brands. But the book warns this is tough to maintain long-term, especially in tech or electronics where innovation moves so fast.
Makes sense. Next source, cost advantages.
This is about being able to produce or deliver your product or service cheaper than anyone else. It could be due to a better process or just massive scale allowing you to negotiate lower input costs or spread fixed costs wider.
Like Dell's direct model and scale giving them a cost edge in PCs back in the day.
Classic example. Or in basic industries like industrial materials, the book says you pretty much have to be the lowest cost producer to survive and thrive. Nucor and Steel is mentioned as a company focused on this.
Okay. Then, high switching costs. This one feels very real. Once you're embedded with a product or service.
It's a pain to switch. It costs the customer time, money, effort, or introduces risk if they move to a competitor. Think about professionals trained on specific software, like Adobe Creative Suite for designers.
Yeah, retraining is costly.
Or ripping out and replacing a huge complex telecom network from a provider like, say, Nortel or Alcatel used to be. Huge undertaking, very risky for the customer.
Though the book notes switching costs aren't always high, like with some medical devices, if the procedure is similar across brands.
Right, it depends on the specifics. It's not a universal rule. Finally, there are high barriers to entry.